Welcome to the ISG Webcast for the first quarter of 2016. I am Howard Coleman, Chief Investment Officer of Coldstream, and with me today is Nina Rose, Portfolio Manager for Elaine Heller's team. As regular listeners to this webcast know, we cover the previous quarter's events for the first part of the call, and for the second part of the call, we'll cover a special topic. Given the movements in the equity markets globally in January, our special topic this month is the Four Horsemen of January and is designed to provide some insights into the factors influencing this month's sell-off. Nina will present a summary of the fourth quarter, which will provide the prelude for events that occurred in January, which I will then discuss. Nina?
Thank you, Howard. Good day. I'll do a bit of recapping the fourth quarter with comments on the year in review. I will introduce slides that are going to include data that is from the beginning of 2016 to gain some perspective on current market action. We recognize that January volatility is on investors' mind, so as Howard mentioned, he's going to introduce the special topic at the end of my comments. First, let us start with taking a look at the investment universe and the corresponding index returns for 2015. It was a tough year for asset allocation in that many of the asset classes had negative returns. Notable detractors were commodities and emerging markets. Domestically, U.S. equities had a very bifurcated returns with small cap index returning negative numbers, while the S&P eked out a tiny gain thanks to the yield on the index, only to give those gains back and then some as we move through the current month of January. The anticipation of Fed action kept traders tied to the short end of the yield curve trying to navigate the corporate and treasury markets. Credit markets were particularly challenging as commodity-related credit pulled the S&P sector into negative territory. In looking at the health of the S&P, market breadth, or the number of stocks participating, was tight. In fact, on this chart, you'll be able to see that had you have owned only the 10 largest stocks in the S&P, returns would have been a positive 17%, versus had those stocks not been included in the index, the returns would have been a dismal negative 5. Now, narrow market breadth is not an indication of a healthy market, and it's something that we will continue to be monitoring. A tech-heavy NASDAQ was a star performer through the index. It's cap-weighted, meaning that larger companies such as Facebook, Amazon, Netflix, and Google were the major contributing force behind the impressive returns for technology. The combined returns for the FANG stocks, which the acronym has been given by the street, were collectively up over 83%. Those of us here in the Northwest would likely add the S on that for Starbucks, making it a complete set of FANGs. Starbucks was up 44%. If we see broadening leadership in the U.S. equity markets from the narrow group of winners in 2015, we could favor stocks currently trading below market multiples and companies that could generate revenue growth. In turning to take a look at the small cap index, which tends to be economically sensitive, small caps got off to a bright start in the beginning of the year, only to give back gains throughout the entire year. Now, small caps actually went into 2015 with a relatively high valuation as they've had an extraordinarily long run over the last 7 years. PEs were in excess of 19 and 20 times earnings. While we think small caps are less impacted by multinational reach of the US dollar, we're going to continue to monitor the small cap index as it is economically sensitive. Now, taking a look at the S&P 500, the way S&P can be summed up was most of the year ended up being in what would be called a trading range. On traders' mind was the Fed, and as we approached every Fed meeting, the S&P 500 stalled out in order to understand what better was happening around the Fed. In August, when most traders are off at the Hamptons, with the exception, of course, of your Coldstream staff, the yuan actually decided the Chinese came out and devalued the yuan. That was truly the first peek into whether or not China was beginning to slow down, and it made the investment community quite jittery, as you can see, the cascading fall that we experienced at the end of August. The S&P moving into right after the third quarter close, the S&P rebounded quite healthily through October, only to give back nearly 3.25% in the month of December. On December 16th, the Fed finally, after years of being at a zero interest rate policy, announced a 25-point basis raise. One thing that we'd like to show and highlight on this chart happens to be the blue line. That blue line represents support, and as you can see, the blue line came into play as the market bounced off of that line that started back in October of 2014. This line will become more and more important as Howard presents what's going on in the month of January. Now, as I mentioned, the Fed certainly did play a role in the range bound that the S&P was for the majority of 2015. The worst kept secret in the entire market was that the Fed intended on raising interest rates at some point in time during 2015. It's thought that the Fed didn't actually go through with the raise in September because the US dollar was quickly gaining strength against another basket of Asian currencies. However, true to form, the Fed did announce a 25-point basis raise with the direction that it would be modest going forward and that they would be data dependent. Now, what's really important about this chart, what you're looking at is the yield curve from this year and the yield curve from last year. And most notably, what's happening on the yield curve is that the front end of the curve, or inside of 2 years, is really what the Fed is able to control, those interest rates within inside of 2 years. As you'll notice, with the exception of the long-dated 30-year bond, yields inside of 2 years drastically changed. What didn't change was what we call the belly of the curve. So as a result, yields on the front half were increasing. The belly of the curve primarily stayed very close to being the same. So we ended up with a flattening, what's called a flattening yield curve. Now, flattening yield curves used to be an indicator of potential for softening in the global economy. But we also have a couple of other things that are playing in the global economy that we haven't really had in the past. And that other piece of information happens to be yields on other sovereigns. So for example, Switzerland actually has a negative yield. Japan recently announced that they would be going into negative yields. And what that means is if you're an investor buying a 1 or a 2-year bond, you actually owe the government money to have the privilege of owning that bond. Now, if we look across the globe and we look at other countries, Germany is at 0.4, France is at 0.7. These are the rates on those countries' 10-year notes. The 10-year note here in the United States stands roughly at around 195. So if you're a major pension company, if you're a large investor or a sovereign wealth fund, and you know that your currency is becoming devalued, it's in your best interest to take your dollars and migrate them over to the United States. That being said, what we think is rates are going to be low for a longer period of time as a result of what's happening in the global community. Not all was really lost in the investments in the yield category. The municipal market has been an outstanding asset class for us to participate in. And as you can see here, the municipals were really unaffected by any of the Fed interest rate rising. Something to really be cognizant about, and we'll page over here and see that we're looking at the high yield municipals, is that municipality health is in very, very good shape. We went into the Great Recession with balance sheets on municipalities overextended. And as a result, since then, municipalities have gotten their balance sheets in better health. Now, it does go without saying that there is quite a bit of what I would call headline risk, meaning a lot of bad news around Puerto Rico, a lot of bad news about the Detroit situation a couple of years ago, and other conversations around municipalities struggling in order to support their pensions. The market itself is well aware of this. Municipalities as a whole are doing quite well. If you look at tax receipts from wages, tax receipts from property values, and tax receipts from retail sales just here in the state of Washington, municipalities have been able to get their balance sheets in order and be able to start saving for a rainy day. That doesn't mean that in the high yield sector we will start seeing some headline risk as Puerto Rico continues to work through its balance sheet. Chicago Board of Education bonds will end up having to be resolved sometime this year, and we're keeping a close eye on New Jersey and Atlantic City. Now, one of the effects of the Fed raising interest rates, as I mentioned why they may delay it, the reason why they delayed it was because there was a devaluation of Asian currencies, but by raising interest rates here in the United States, as you can see from the chart, the trade-weighted US dollar index, which is a broad basket of all of the sovereigns that we trade with, the dollar has been appreciating for the last several years. Now, we talked a little bit about how that was the case as other money from other sovereigns was coming in, buying up dollars or buying up our interest rates and buying a high demand for our debt has held interest rates down, but it has also appreciated the US dollar. Now, why this really matters is this is what's starting to put pressure on the S&P 500 multinational corporations that actually sell in other countries that have a weakened currency. We're starting to see the impacts based on corporate profits, particularly as 2016 started to open. What also matters for this dollar is that it is a direct correlation. The price of the dollar and the price of commodities are directly correlated, or at least it's very highly correlated. So what that means is, as the dollar continues to strengthen, commodities actually become less expensive. What you're looking at is the GCC, which is a broad basket of commodities made up of metals and softs and agriculture. As you can see, this has been more or less pretty much a slow bleed since the middle of last year, middle of 2014, when oil prices were in excess of $100 and have now consequently moved down closer to the $30 range. This dollar dynamic really has a lot to do with the dollar dynamic that's going on has a lot to do with other emerging markets. But one thing to keep in mind is how the dollar is actually correlated to oil. On the left side of the chart, you'll see gold, oil is in the gold line, and the white line is the US dollar. So the gold line is actually going down in price as the white line is going up in price. What that means is the dollar and oil are negatively or inversely correlated. Now, why that means something is, yeah, it feels good here in the United States to buy gas cheaper, but what it's doing is it's giving a little bit of trouble to the build out that we've seen here in the United States on our energy sector. For the past 7 or 8 years, we certainly have been producing more oil and building out our shale and fracking reserves. So the idea was years ago, as oil was in that $90, $100 barrel range, it was very cost effective to borrow large amounts of money and be able to service the debt while oil was at an all-time high. Since then, as you can see from the chart, high yield spreads in the oil sector actually coincide with the beginning of the fall of the price of oil. We also are seeing that effect in the materials and mining sectors. And so we'll be needing to keep a very close eye on how these high yield sector ends up playing out. We do think we're going to see cluster bankruptcies sometime in the second half of next year, but fortunately the market has that already priced in. Now, one other piece that the strong dollar, and the low price of commodities is really affecting is actually the emerging markets. Emerging markets, again, coincides with the peak of the emerging markets coincides with the peak of oil. Emerging markets as a whole are producers of commodities, and they export those commodities over to, in this case, a lot of cases, it's going to be China where they're doing their exports. We went into 2015 looking at emerging markets as actually an opportunity because the price to earnings was in the high single digits. So relatively compared to other asset classes that we had a choice in, emerging markets looked to be at a fair valuation. Little did we realize that commodities would continue to slide through the entire year of 2015, taking down the emerging markets with it. That being said, emerging markets are largely dependent on our friends over in China for consumption. I've put up the casino called the Shanghai Composite just to put some things in perspective for you. Now, Shanghai Composite isn't necessarily what we think of as the S&P 500 or the Dow Jones. Stocks that are inside the Shanghai Composite largely are state-owned enterprises. In thinking about it this way, we look at the Shanghai as more of a litmus test on retail population indicative of sentiment to the retail population in China, being as the Shanghai functions more as a casino. A couple of examples of how the state is very involved in this particular index is, in the front half of 2014, property values were getting very overheated in China. The government encouraged folks to move out of property and start investing in the stock market. Things didn't go so well in the middle of 2015 as the Shanghai nearly doubled. In order to take some of the air out of the market, the Chinese ended up not allowing short selling and ended up having a very hard time controlling their marketplace because it no longer was a free market. A lot of what has happened here in the United States has something to do with the way that the markets in Shanghai were functioning in the beginning of the year by continuing to allow short selling. And I'll let Howard cover that in a bit. So what does all of 2015 really mean to us? Well, we're highly data dependent individuals. So we look at the same types of things that the Fed is looking at, leading economic indicators. Now, while we do see economic indicators are starting to slow down, they haven't necessarily rolled over. And some of the most important aspects of it, unemployment, consumer sentiment, new factory orders, they are slowing, and it's something we will be keeping an eye on. However, we still feel that the United States continues to grow, albeit at a slow pace, but it looks to be a favorable place to continue to invest. Now I'm going to turn it over to Howard to speak a little bit more on 2016's market action the first month.
Thank you, Nina. Many of the themes of 2015 that Nina discussed have continued into January 2016 and in some cases actually accelerated. As the title of this presentation indicates, I will discuss 4 of them. I will discuss oil, China, the Fed, and regulation, all having an impact into what's occurred in markets in 2016. Of the 4 horsemen I will discuss today, oil has had the most direct correlation with the U.S. equity markets, and I will spend most of the time discussing what's occurred in the oil markets. The first slide shows the 2 things. It shows the E-mini S&P, which is the S&P futures market, and it shows crude oil prices in the U.S., WTI. It shows it from the middle of December through the end of January. And as you can see, these 2 instruments are very highly correlated. Their movements are virtually identical. What's important to recognize is this is not always the case historically. In fact, it's far more rare than it is occurring. And typically in the past, when you've seen declines in oil that have correlated with declines in the S&P, It is because in the oil markets, you've seen demand be significantly curtailed. And demand is curtailed in times of a recession because consumers aren't able to buy or gas or fly or use oil in the same ways they normally do. And so you see that price of oil drop along with the price of the S&P because stocks suffer in a recession as well. Interestingly, that is not the case this time. This is not a demand-driven situation. It is a supply-driven situation, and Nina touched on this in the first half of her presentation. Production has greatly increased in the U.S. The world is really awash in oil at the current time. And this next slide shows U.S. crude oil stocks. And when we talk about stocks, we're not talking about equities. We're talking about inventory. And the gray area indicates the 5-year range of inventories. And you can see they accelerate generally in the March to June timeframe because people were buying lots of oil and drawing down inventories in the winter for home heating oil, things of that nature. This year, however, the inventory in oil is significantly higher than the historical range, and it's been so for about a year. And this is very interesting because this is despite the fact that rig count has been dramatically declining. I imagine many of you have read in the popular press about the fact that oil production is being cut in the U.S. as you would expect in response to low pricing. But because many of the wells have already been drilled and it makes no sense to stop producing, and because wells are more efficient, and the more efficient wells are staying online and the less efficient wells are closing, inventory has not decreased. We thought it was toward December, but the most recent reading, as you can see here, the bar chart, the last reading in January, stocks have shot up again. What is really amazing is despite the fact that many rigs have not been profitable, U.S. crude oil production this year, represented by the blue line, continues to exceed U.S. oil production last year, despite the fall in oil prices. So I want to give the caveat first, which is one can never predict geopolitical events, and we know that Russia right now is lobbying OPEC to try to finally input some production controls. The news is that Saudi Arabia rejected those overtures, but again, this is all secondhand. Nobody knows for sure. But absent some significant macro event, we expect, given the supply-demand equation, oil prices to stay relatively low for a period of time. Now, the decline in oil prices has been puzzling to some extent because Nina well expressed the fact that many oil-producing companies are in trouble, that are smaller companies that are highly leveraged. But at the same time, oil can provide a wind in the U.S. consumer's back. We all are enjoying cheaper gas prices. I know I filled up for $2.12 this weekend and was very happy. It puts more money in all of our pockets. So it has a salient effect as well as a harmful effect. And so in some ways, the correlation has been confusing. None more confusing than this correlation that I'm showing you right now. The green line you're seeing is the price of airline index. That's airline stocks. This is the price of crude oil and airline index. But anyway, this is what's very confusing because what are the input costs in the airline business? Number one is labor and number two is fuel. And you would think as fuel got cheaper, airline stocks would do better. Again, in a recessionary environment that's demand-driven, you could see them both falling together. But again, this is a supply issue. The U.S. consumer is doing very well, and it doesn't make a lot of sense that airline stocks are falling in line with oil stocks. Nina also spoke about high-yield energy spreads, high-yield spreads of companies that are energy-producing companies. And what spreads mean is the difference between what you would get for a treasury versus what you would get for a high-yield bond. And here you see right now you're getting about 13% more for a high-yield U.S. energy bond than you would for a U.S. treasury. Kind of interesting, right? Until you consider the danger of those companies defaulting. And that's the reason for the spread. What I'm more interested in right now is the lower line. And that's high yield stocks, riskier companies that exclude energy and metals. So these are companies where default rates are actually very low, and there's no real anticipation that they're going to catapult higher. They may gradually go higher, but there's no inclination like in energy stocks that they're going to catapult higher. But you can see that the spreads for high yield stocks absent energy have risen as well. And that's due to what's called contagion, just the trickle-on effects from energy stocks, energy bonds blowing out. We are watching this very closely because if these spreads continue to widen significantly, we'd be concerned that something more is happening in the markets. Now, there's been three explanations that I have heard as to why this correlation between oil and equities exists. And I want to walk through each of the three kind of in an order of the most benign to the most worrisome. So the most benign, and something that's certainly contributing, but we really don't know how much, is sovereign wealth funds. Now, these are countries, as you can see, UAE, Norway, Kuwait, Qatar. What do they all have in common? They are oil exporters, and over time they have a very good balance of payments. They are exporting a lot more than they're importing, and they're banking the cash, and since oil trades in dollars, the cash is in US dollars. And they have these sovereign wealth funds that are essentially rainy day funds. Now, the other non-oil producing countries are China and Hong Kong and Singapore, all countries with very strong trade balances, but all who are suffering slowdowns right now as well. One of the theories as to why oil prices are going down is that these companies are selling their equities. This is why the equity markets are going down and the bond markets are going down. These companies invest in equities and bonds as a way to generate income for their country off of their savings. Given the fact that oil price have declined so significantly, these countries are now selling their stocks and their bonds that they hold in their sovereign wealth fund to raise revenue to balance their budget. JP Morgan is a proponent of this. They have said that about $110 billion in bonds have been sold and about $75 billion in equities from sovereign wealth funds, which in and of itself would not explain the decline, but is a substantial amount and could trigger others to sell as well. That's theory number one. Theory number two, what you see here is the chart of a Brazilian company and the debt of that Brazilian company. The company is Petrobras. Petrobras is an oil and gas producing company in Brazil. It is not state-owned, but it is Brazil's largest company. As you can see, it has been significantly accumulating debt. And that correlation of them accumulating, that company accumulating debt is very high to the decline in the price of oil because they're dependent on oil for their revenue. The fear is that some large emerging market companies that are dependent on oil prices and the countries in which they are located will default, and that default could have ripple effects throughout the world. Now, one of those countries I think the world expects a default from, and that is Venezuela, but that's too small to make a difference, really. But if Brazil or Russia default, that could have ripple effects. And there are some that believe that the jitteriness in the equity markets is due to long-term concerns about the financial health of these countries. The third, and what I find the most troublesome explanation, although I tend not to agree with it, is that what the market is portending is actually a demand slowdown that's being caused by the Chinese economy slowing down. And it is clearly true that energy consumption in China has dramatically decreased from 2010 to 2015. What you will notice, though, is that the price of oil in those early years did not dramatically decline while their energy consumption declined. But the fear is that this market downturn is a precursor to the fact that there actually will be a demand problem that could spark a global recession. However, the decline in energy consumption in China is not only due to a slowdown in the economy, because in 2012, you'll recall the Chinese economy was growing at 12%, and it's still, that blue line shows it was slowing down. GDP was still pretty good. It represents a change that the Chinese administration is trying to effectuate in China, which is changing the economy from a manufacturing economy to a service-based economy, which means less construction, which means less energy consumption. And so let me turn to China and discuss the implications of the Chinese slowdown to the world economy. One of the difficulties in measuring whether there is a Chinese slowdown is that nobody trusts the numbers coming out of China. The blue line, the dark blue line, represents the official GDP estimates of China. And even the blue line shows a decreasing GDP, but it still is a very steady, nice slowdown. Barclays, which is the, I guess, the bright blue line, is trying to measure independently, difficult task, what the slowdown looks like in China. And as you can see in the fourth quarter of 2015, they think the slowdown is about 5.6% growth, not recessionary, but 5.6% growth versus a reported growth of 6.8% out of the government. 5.6% is slow for China, but would not be slow for anyone else in the world. So it is not indicative of a hard landing. It is indicative of a slowing that we must continue to watch. And as I mentioned, part of the slowing is purposeful, an attempt to change the nature of the economy to a consumer-driven economy like the U.S. is. But the slowdown has been more pronounced than the government authorities would have wished. And this is one of the most worrisome things in regard to the slowdown, but also indicative of the change of the Chinese economy. The PMI is the Purchasers Manufacturing Index. It's a measure of manufacturing in China, and below 50 is considered contraction. So we've seen for quite some time, a year now, the new number just came out on Monday, and it is again low in around 48. So we've had a year of contraction in Chinese manufacturing. Now, this is a chart of the yuan, and the yuan is the red line, and the S&P is the yellow line. And you can see that the yuan, the Chinese currency, and the S&P are very highly correlated. And as Nina talked about, in August of last year, when the Chinese devalued, the U.S. equity market took a big hit in regard to that valuation. Now, the problem with the devaluation of the yuan for the Chinese authorities is that it makes it more difficult to effectuate the transition between a manufacturing economy and a service-based economy, because as the yuan cheapens, the dollar becomes more expensive, and it becomes more expensive for the Chinese consumer to buy goods outside their country. It does, however, make their exports cheaper. It encourages manufacturing, and it would provide a boon to the economy by doing so. So the devaluation was necessary because as the dollar strengthened, the yuan strengthened, and their exports became more and more expensive and would have led to a greater and greater slowdown. So they had to devalue to keep their exports reasonably priced to keep their economy from collapsing. But it has had the effect of delaying the transition the government authorities want. Now, the implications for China have spread, as Nina talked about, to the emerging markets throughout, especially in surrounding Asian countries, but also into commodity-producing countries as well, as Nina showed the impact of commodity prices and the dollar around the world and how those prices have significantly fallen. This hurts emerging market commodity-producing countries, and their stock markets have taken a significant hit. Investors from the developed world, from Europe and Asia, have pulled their money in record numbers. And this chart here shows this. This chart shows capital flows to emerging market economies. And you can see in 2015, we have had record outflows. Americans and Europeans and foreigners are pulling their money out of EM economies, and their stock markets have collapsed. Now, this has created enormous opportunity in these markets in the long run because valuations are very attractive. In fact, the Hong Kong stock market as a whole right now is trading at 1 times book value. Very, very cheap. We think it's too early to get back into the emerging markets right now because the technicals are very, very worrisome. But this actually is a bullish sign going forward because the money has been pulled out. When sentiment changes, it'll flow back in and these markets will run, but not yet. Now, Nina mentioned commodities and how we've had a fall off in commodities. This is a chart and the right-hand column shows the percent that these individual commodities are below their all-time high. And you can see gas is 85%, natural gas is 85% below their all-time high. Crude oil, 75% below their all-time high, and on and on and on. And this, of course, has had ripple effects for emerging market economies. Now, luckily for the U.S. economy, our share of exports to emerging markets are relatively low, just over 3%. Compare that to Germany, which almost has 13% export share to emerging markets. And when I talk about export share, that's the percent of GDP that's tied up in exports to emerging markets. Now, so a slowdown in China as what we call a first order effect shouldn't have that big of an effect on the U.S. economy because we actually don't have that much of an economic exposure to China. It could, however, have what we would call second order effects. In other words, it could affect Germany and other countries that have exposure to China. Their economies could slow, and we have more exposure to those economies, which would result in us slowing as well. The third thing I would like to discuss is the Fed, and Nina really did a very good job of going over interest rates, and I'm not going to repeat a lot of that. But this is one important chart which shows where we are in relation to the rest of the world in our central banks raising or lowering interest rates. And as you can see, only us and Brazil are hiking rates right now, and Brazil is a mess. Brazil has high inflation and a recession, kind of like the U.S. in the late 70s, but even worse. And the government is being forced to hike rates to curb inflation, even though the economy is slowing. But the rest of the world has very little inflation as a whole. Central banks are trying to stimulate their economies, and they're cutting rates. As Nina mentioned, Japan just recently cut their rate, their deposit rate, now not their interest rate, but the deposit rate, which means when a bank puts money with the government because they can't, they're parking it with the government, they actually have to pay the government to park their money there. But we are in a different place than the rest of the world, and this has resulted in a very interesting situation. And Nina mentioned this, but I thought this chart is just important because it really brings it home. In the red pink boxes are the interest rates that you would earn by investing in a government bond in those countries for that tenure. So for the first line, if you invested in a 5-year bond for Switzerland, you'd pay the government 60 basis points for the privilege of owning that bond. You would lose 60 basis points per year just to hold that bond. In Austria, 3 basis points. But even if you went out 10 years, giving the government your money for 10 years, you would earn 62 basis points. In Switzerland, you'd actually lose money for 10 years. It's just astounding. So what does that mean for the U.S.? Well, our rates, the 10-year, are hovering around 192 to 2% to 210 in that range. And there was, a couple years ago, we had a taper tantrum when we all thought that when the Fed would begin raising rates, U.S. interest rates would skyrocket. And they haven't. There's several reasons for this. One, our economy it's still positive, but it is clearly slowing. But number two, as Nina said, if you had a choice of investing in Switzerland 10 years at minus 6 bips, or Germany for 10 years at 62 bips, or the U.S. at 2%, you would pick the U.S. And because there will be demand for those bonds, That will keep a lid on rates. Now, one thing that will be coming on is there'll be a lot of supply on the market in the near future. And if that supply is not lapped up, then interest rates would rise. Prices and interest rates on bonds move in the opposite direction. So when prices decrease, interest rates go up on those bonds. So the question will be, will the market be able to absorb this supply so that prices won't have to go low, won't have to go high and rates go lower? There's plenty of demand for these bonds, and we don't really anticipate any rise in interest rates as a result of the fact that there are so many bonds that are going to be rolling over in the next few years, given the differential between U.S. rates and the rest of the world. Now, the Fed is predicting, their dot plot still says that they're going to raise rates 4 times this next year. The market doesn't believe it. The market is pricing in between 1 and 2 rate hikes this year. We think that's much more realistic. We think that if the Fed did raise 4 times, you would be raising into a slowdown. The dollar would strengthen enormously, and that would dramatically hurt international corporations, U.S. corporations selling internationally. It would really crush their earnings. We don't think the Fed would want to do that. The final thing, and I just want to touch on this briefly, is regulation, because it's not talked about that much, and it really affects the bond markets the most. Junky companies, high-yield companies, risky companies have issued more bonds since 2010 than they ever have before. They've raised money, they've taken advantage of cheap interest rates and the chase for yield, and raised an enormous amount of money over the last 5 years. At the same time that they've raised money, and they are raising money, I want to call your attention to the pink line. The pink line shows this is dealer inventory. This is how much the banks and others keep bonds in inventory. Pre-regulation, banks used to keep bonds in their inventory. They used to keep it on their balance sheet, and they would provide grease to the wheels of commerce when it came to buying and selling bonds. They would buy your bond and put it in inventory. They would sell an bond in inventory. So they provided liquidity to the markets. With one exception, which was 2008, when they didn't provide liquidity because they were massive sellers and actually hurt liquidity in the markets. But in absent times of extreme stress, they helped to provide liquidity. They served as the buyer and seller often of last resort. Because of regulation, the penalties for them to hold those bonds in inventory are so severe they can no longer do it. And when I say penalties, they have to hold other assets on their balance sheet against those bonds. And it becomes very restrictive of what the banks can do elsewhere if they hold those bonds on the balance sheet. So they're not holding them anymore. And what's replaced them is mutual funds that have daily liquidity. And if the mutual funds suffer redemptions, they have to sell. If they have subscriptions, they have to buy. And if there's not a market that has a lot of inventory available, the price between what people will sell their bond for and the price what people will buy their bond for widens dramatically. That's the spread, bid-ask spread in trader parlance. And when bid-ask spreads rise, liquidity either dries up or volatility increases dramatically. And that's what we've seen happen in the high yield market, and part of that has to do with regulation. I want to conclude just to talk about, bring us back home to fundamentals. As Nina did with the LEI, I just want to remind us all of what the components of the U.S. gross domestic product is, our economy. And it's 68% consumer and 13% housing. 3% housing. So it's 71% of the U.S. economy is really based on your and my spending. And the U.S. consumer is in good shape. We have delevered dramatically since 2008. Our credit card debt is low, our mortgage debt is low, and we are experiencing a wind in our back in terms of oil prices that we're paying, and the job market and unemployment is relatively low as well. So we're in fairly good shape from that perspective. The investment ex housing, a lot of that is manufacturing. That is not in good shape. That has contracted has continued to contract over the last several quarters. And government spending, the sequester that existed for years, is now over, and so now government spending is increasing. So the fundamentals of the U.S. economy, although clearly slowing, do not appear to us to be recessionary in the very near future, given how this economy is constructed and what's occurring. Finally, Nina mentioned this, and this is what we are watching. We are not technicians here, but we do pay attention to technical indicators, and we are paying close attention to this. This is called a triple bottom, and what we're seeing here is the S&P, and Nina showed you this before as well. And this is the line where on 3 occasions the S&P dropped to and then bounced off of. And that's a very good technical sign. If it breaks through that indicator and tests that indicator again and breaks through it, that will be a technical area of concern for us. As you may recall, and as you may have seen, a couple weeks ago we did send out a communication to our clients where we told them that we were moving to a more conservative, somewhat more conservative stance in client portfolios. Of course, how that will affect your individual portfolio is between you and your relationship manager and portfolio manager, because we run customized portfolios, so it will vary from client to client. But the general message has been that we are going to go slightly more conservative because of the technical factors that are happening in the market. If we break through this 1850 level on a sustained basis, we may tilt slightly more toward a conservative position. Right now, the market has not tested that again, but we are keeping a very close eye on that. So thank you very much for your attention today. We enjoyed the presentation. We do have a question, and it may take us a minute or two to discern it, so I ask for your patience as to what we. Very good question. The question that that one of our listeners asks is this: the decline in oil prices have not yet resulted in an increase in consumer spending, but has actually resulted in an increase in savings. There has been some increase in consumer spending, but not what one would think of from a typical price decline in oil, and we acknowledge that. I don't have a great answer for that. I do believe, however, that as these price declines continue, you will see an increase in consumer spending, and in certain sectors you actually have, specifically auto sales. Auto sales have gone, have grown by a great amount since the oil price decline. So that is the one area you've seen it. I am surprised we haven't seen it in other sectors. I do think we will see it eventually. Being no further questions, thank you very much for your time. If you have any further questions, please contact your relationship manager or your portfolio manager. Thank you again. We'll see you next quarter.